You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Most options trading platforms are commission-free, and there are some that don't charge per contract fees. Public.com goes a step further. When you trade options on Public, there are no commissions, no per-contract fees, and you get a rebate of up to 18 cents per contract traded. That means it costs less than $0 per transaction. In other words, instead of paying to place options trades, you literally earn money, and that money can add up fast. If you trade 1,000 option contracts on Public, you'll earn up to $180 in rebates. 10,000 contracts? Up to almost $1,200. It's pretty obvious why NerdWallet recently gave options trading on Public 5 out of 5 stars. Because Public really stands out for the cost of its options trades. Their words, not ours. If you want to start paying less than $0 to trade options, check out Public.com and get a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back live on Education Wednesday. Time once again for a little bit of everyone's favorite options educational program. Yep, it's time for Options Boot Camp, what the cool kids call OBC. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which all you folks are binging. Did you miss me? Did you miss us? Of course, if you're listening on the feed, you really didn't notice any difference. It hit you last week as usual, but Dan and I, of course, were not live last week because I was down at the Options Industry Conference in Asheville, North Carolina, getting the lay of the options land, kind of getting a sense for what the big issues, the big tumult is in the world of options out there. So fascinating stuff. We'll get to that all, I think, in a little bit. Of course, if you like what you hear, this show, anything else that we do out here, throw a like, a star, a comment. All that stuff does help. A rating, a review, all that stuff does help. Doesn't matter what platform. People consume these shows on a variety of platforms, including more of you coming in via LinkedIn, which is always fun. This week's review comes from Paul Polesh. I apologize if I mispronounced that. He says, Mark, I'm a recent convert to options trading and have learned much from your podcast, mainly OBC, and now branching off into the others. Thank you. I look forward to continuing to learn as fast as I can. Warm regards, Paul. I love our listeners. You folks are just the nicest bunch out there. And again, you can get the content just about every platform under the sun. It doesn't have to be your Audibles or your iTunes or Google Podcasts doesn't even exist anymore. Your Spotify's. A growing number of you coming in via YouTube. You may have seen some rejiggering on our YouTube channel. So all of a sudden, a lot of old stuff's being recirculated. That's just because we're kind of updating the way it works over there. So you might be seeing some stuff from years ago, which is kind of fun. People are going in there and commenting and chiming in on it. So if you like to listen via YouTube, that is available for you as well. So again, wherever you get the shows, even LinkedIn, a lot of you folks reach out all the time, ask to connect. I'm a nice guy. Sure, I do that. Just be nice, be respectful, just like our listener Paul here. And I'm happy to connect with you folks and help you out any way that I can. And speaking of help, or maybe not, maybe he's wearing his black hat this week, which he usually is, in which case he will be a dubious helper. He is none other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call to Mr. P, welcome back to the show. How goes that black hat? Is it fitting snugly on your head this week, sir?
Oh, hey, Mark. It is going great. The black hats, it's hanging up in the closet. I just pull it out for special occasions. But, I got it for when I need it, though. I got it for when I need it. That's the important thing.
For when you need it. And you're going to need it right now, sir, because it is time for a little bit of basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn. Yes,
all right, everybody, welcome to a little bit of the old basic training. And as I mentioned, I was down at the OIC conference last week, so an intriguing time. If you're listening to the full network, and again, you should be if you're listening to this, you will be hearing all my audio from down there. You'll be getting, of course, all of my interviews with folks, including the folks with Robinhood, talking to them about options education, all kinds of things out there. And also, we got all the panel audio for you folks. So because we like you, you don't have to go to Asheville. We went for you. So we saved you the trip, we saved you the hotel, we saved you the registration fee, which is not insignificant. It's a pricey conference. You guys get it all for free because we like you folks. So make sure wherever you're listening to Options Bootcamp, make sure you're upgraded to the full network. That'll be hitting us on the regular network as well as, of course, on our special events feed where we put out event and conference audio out there. So it was a fun time. Dan, we missed you down in Asheville this year. Any lack of buyer's remorse? Yeah, I saw Mr. Overby down there, so he's floating around, which was kind of good to see him in person. But I know you've gone in the past, not this year, huh?
No, I didn't go this year. I have got so many things that I'm working on. It's crazy. And so I couldn't get away.
I get it. That day drinking, those bottles are not going to drink themselves, sir. So if you leave them, who's going to drink? Who's going to drink the hard, what do they call it? They call it the Frankfurt Hooch, I believe. You make it in your bathtub. Pretty good stuff from what I hear out there. Can also clean your radiator, all sorts of uses for Frankfurt Hooch.
Well, I have made wine in my basement. I have done that.
Oh, well, there we go. So yes. I was not far from the mark. Wine a little bit different, I will give you that. I come from a long line of Italians who've been known to make a little bit of vino in the old basement. So yes, it does run in our blood, sir. But let's see what was running in our audience's blood, or in this case, perhaps their preferences. We asked them last week as we were heading down to the conference, listener. We said, it's almost time to catch up with the entire options industry down at OIC 2024. We're going to be setting up our studio again to talk to everybody. What would you like us to talk about? Gave you 3 choices, and of course, you can write in with your own. We gave you the impact of zero-day options. We gave you 24-hour stock and option trading, the options volume surge. Can it continue? Is it starting to peter out? And other. And Dan, it was a closely contested affair. Early on, zero-day ran away with it, like 75% of the early voting. As the week started to go on, though, the 24-hour stock trading thing really took off. That ended up winning it, Dan, with 45.8% at the end of the week. So that kind of surprised me. That even surpassed zero-day. Zero-day came in at number 2, 41.7%. The options volume, number 3, 8.3%. And then bringing up the rear was a lot of interesting write-ins, including a lot of you writing in for when are we going to get options on Bitcoin ETFs. So luckily for you folks, and again, you can hear all the audio for yourselves. I had lengthy conversations with a bunch of exchange heads and broker heads and everyone else, the folks who are really going to be implementing this stuff over the next, let's say, couple of years, and what their opinions are on these topics you want us to talk about. So a couple of things I took away from my conversations, Dan. First off, if you're sitting there really holding out hope for options on the Bitcoin ETFs, you might want to move that attention elsewhere. The gist I got from a lot of my conversations was it ain't happening anytime soon. It does seem like the commission, unfortunately, not exactly excited. They'll approve the underlying, Dan, but if you want to buy a put on said underlying, oh no, that takes years of study and research. I thought we were past this, but apparently not. So, Dan, if you were sitting there drinking your hooch and waiting to trade options on the Bitcoin ETFs, I'm afraid I might have some bad news for you, sir.
Yeah, well, the SEC does not want you managing your risk when it comes to crypto. It's just too safe. And so let's keep risk management tools out of the hands of investors.
Sling the underlying all you want. Short the hell out of that ETF all you want. But if you want to buy a put, they're going to smack your hand and say no to you. So that was the gist I got, is that they are deeply uncomfortable with that concept, and it's going to be a while. So don't get your hopes up on that. Also, maybe temper your expectations. I heard a little bit of a back and forth. And again, you could hear this for yourselves. Obviously, when people are talking to me down there, Dan, they're talking their book. So exchanges want certain things. Brokers want other things. So you have to kind of read between the lines sometimes when you're talking to these people, listeners. But I did get the gist that we are also not close on what everyone wants. The 0-day Tesla, the 0-day NVIDIA, Dan. Just for all the reasons we've said before, the after-hours contra-exercise stuff is still an issue. Market makers don't want them to get rid of that, I should say, because they use that. They use that in their function to hedge their risk at the end of the day. So doesn't seem like that's going to happen anytime soon. Also, what surprised me, Dan, was that I thought this was kind of kibosh now. I had heard for a while that there was going to be maybe a new series of cash-settled equity options, and that was going to be the end run around this, because the exercise and settlement and stock flying everywhere after hours, that's what they want to avoid. So cash-settled avoids that. To me, that seemed like just throwing more fuel on the confusion fire. Now we have a whole new set of options. Now, if you go to your options chain, you got to click on Tesla. Is it Tesla traditional, OG Tesla, or is it cash settled? That seemed to me to be just a non-starter. But the brokers do seem to want that. The brokers have agitated for that. So maybe it's not as much of a non-starter as I thought, Dan. So maybe we might end up getting cash settled equity options first and then the 0-day Tesla. What do you think about that? Would you like that?
Well, I mean, I don't know. I wonder if the brokers like it because then there's less labor involved with putting through assignments and, worrying about the, T+1 settlement as of the end of May, I think. Maybe it's just easier and cheaper to process it into cash.
I think there's some of that. I think if we had to do it over again as an options industry, they probably would go cash settled. It's just more straightforward. It's easier. You don't have to deal with the stock flying fast and furious. I have heard from a lot of brokers who are concerned about this, some sort of nightmarish scenario where there's a big move in the after hours and a lot of retail don't know or just aren't aware that they can go in and issue exercise or contra exercise orders in this case. And so they're afraid a lot of retail are going to come in, let's say on Monday morning after a big earnings announcement on Friday, and be short a boatload of stock or long, whatever the case may be, and have a whole bunch of unanticipated risk, and it's going to wipe a lot of people out and cause a very bad experience. That seems what the retail brokers are really concerned about. So they seem like cash settled is the way they want to go, which again, I don't look forward to. I mean, you're going to be dealing with this a lot, Dan, too. All the emails. I sold puts in Apple. Why didn't I get the stock? Oh, well, you sold the cash settled, sir. And I didn't know that. That just seems to me to introduce it now. You have two chains. I mean, how's it going to work? It just seems like maybe if we could have done it to start with, maybe. But these days, I don't know. It seems like maybe a bit of a non-starter. But that seems like what the retail brokers are agitating for, which kind of surprised me. The other thing that really surprised me, which kind of leads me to our topic of this week, Dan. If I had told you when I went down to OIC in the year of our Lord 2024, and I told you coming back out of it, aside from 0-day and a couple other things, the hottest thing that everyone's going to be obsessed with is Flex in 2024. What would you have said to me? Would you have called me a madman?
I still call you a madman,
but
yes, that's very, very surprising. Yes.
I had to make sure my equipment was working. I was like, did you just say Flex? And then when everybody kept saying Flex, I was like, oh, okay, I guess we're doing Flex again in 2024, which leads us to our topic of the week, listeners. What the F are flex options? You would be forgiven for not knowing, because they really aren't relevant to retail, with a caveat, and I'll get to that in a second. But effectively, what flex are non-standard options. It could be anything. Could be a different strike price. It could be a different month. It could be European versus American, which is a popular one out there. What it means is effectively a big institutional customer is saying, hey, you know, I don't like what you've got listed out there. I need perhaps this strike, or I want to go out farther, or I want a different expiration, or whatever the case may be. But they want something different, and they're willing to do enough size to make it worth the market maker's while to come and quote them this flex option. And so that's what that is. A flex is really just a non-standard option. Is it viable for retail? Not really. Like I said, it's all an RFQ market, means you quest for quotes. So you have to go hit up it could be a big bank, maybe will do it for you, or maybe a big market making firm, and say, hey, you know, I need, for some reason, the Tesla standard is not working for me. I need this other expiration, this other strike. Will you quote it for me? And if you're looking for a 10 lot, the answer is going to be no. If you're coming in for thousands, then the answer will probably be, oh, we'll think about it. And then what they're going to do is make you a very wide market, because, again, it's non-standard. They don't have much to base it off of. And so sometimes you come in the middle and they try to execute some sort of trade therein. If you're a big customer, a big bank's probably going to be willing to step up and make a trade that they otherwise wouldn't be willing to do just to keep you happy. But that's what's going up in flex. Dan, I never really did a lot of flex market making, because back when I was on the SIBO, it was all stuff that was 5 years out and crazy, super wide. And I didn't want to wear this stuff on my books forever, because that's what you do. There's no way of getting out of it, really. So I didn't really trade a lot of flex. Did you trade flex back in the day?
I avoided the really long-term ones for the same reason, but I put on a couple of flex positions in my career. Barely any, 0.001%. I tried not to, because you can't get out of them. Like, you have to get out of them, either wait for that person who put it on to take it off, or basically just trade other stuff that offsets it. And it's just messy. It's a hassle.
Yeah, whatever you put on, listeners, you're wearing it, which is why the market is wide. The market maker knows he's doing effectively a one-of-one trade, and hoping the other person comes back the other way to take it off eventually. So yeah, you could obviously, if it's close to what's listed, you can kind of hedge it approximately with that stuff, but it's very much a trade you're kind of locked into, which is, again, why the market is going to be pretty wide. I bring it up for a couple of reasons. First off, exchanges are super giddy about it now. Like, when I thought flex, Dan, I mostly thought SIBO. That's kind of where a lot of that stuff seemed to go up. But it seems like NYSE, others are all putting up a bunch of flex these days. So flex is the new hot thing. So expect the exchanges to put a lot of money into upgrading and improving their flex offerings. So that's interesting. Why does that impact you, the retail options trader? A couple of things. First off, flex size, Dan, I'm not sure if you're aware of this. The size of the OI in some of these flex trades starting to grow. There are some names, I was just talking about this with our buddy, the flow master, Mr. Henry Schwartz, down at OIC last week. Certain names like Nikola, granted that's a cheaper name now, but certain names like Nikola have more options outstanding in the flex than they do in the listed. Isn't that crazy?
Wow, that is very surprising.
Yes. So that's starting to become a thing now. So flex, a growing concern, whereas in the past you could kind of safely ignore it and you were fine. So you missed out on a couple of 10,000 lots here or there that expire in 5 years. No big deal. Now we're seeing size go up in the flex, Dan, to the point where sometimes it can dramatically outpace or be similar in size to the listed. So if you're looking at activity, if you're scanning for a name and seeing what's open in that name, if you're not looking at the flex, you're kind of missing a big part of the puzzle now. So thankfully, talking to folks, and again, this is why I always plug the Trade Alert stuff, not just because they're a sponsor on the network. I've known Henry since pretty much before we started doing this. And I use his platform. There's a reason why I use it above most. It's because they do cool stuff like this. He's going to start adding in the flex, Dan. So if you type in, let's say Tesla, and you hit that button to see what's open and all that kind of stuff, all the different commands, it's going to show you the flex now alongside the listed. So if there is a size flex position, you will be aware of it. So that's kind of interesting. I don't think this is going to matriculate out to the brokerage scanning tools anytime soon. So If you're reliant on those, probably not yet, but something to bear in mind. If you see some flow going up in a name and you really can't make heads or tails of why someone would do this, and a good chance maybe try to take a look at the flex or ask us. We'll take a look for you. And maybe there's something in the flex that might make it make a little more sense. Not all the time, Dan, but sometimes. So what are your thoughts on this growing presence of flex in 2024? Everything old is new again. That was the theme of the show, sir.
Yeah. It's smart that they're going to display it alongside the other stuff, because that's the problem. Like, if you are a market maker, you have to make your markets really wide because, like you said, you're wearing it, you can't get out of it. But if there are people out there who know about it, I don't know. It's like a shiny red ball on an end cap, like, oh, geez, what is that? Oh, yeah, actually that kind of fits. Maybe I'll trade that, which is better for the market makers, which is better for liquidity, which is better for everybody. So it's interesting. It's really interesting. I'm caught off guard for sure.
By the way, your dog seems very excited about flex. She's slinging some flex now as we speak, sir.
Oh, she trades flex like crazy.
Isn't that her name, Flexi? Isn't that Flexi?
Yeah, that's right.
You named it from the one flex trade you did 20 years ago. The other thing that's driving this resurgence of flex, Dan, is rates. Rates are obviously a thing again. So we're seeing a lot of revcons, size revcons going up in flex, which is interesting, because they can come in, do their RevCon, Dan, which, listeners, if you don't know what that is, go back and check out our early episodes on synthetics. Effectively, reversal conversions is the trade we're talking about. You own, let's say, an underlying position, and you sell call, buy put on some strike against it, so you have a long and short synthetic underlying position, and you're doing effectively a carry or an interest rate play. And a lot of RevCons are going up now in flex for size, Dan, because they're using the flex to make them European, so they don't get hit on the early assignment risk or anything like that. So they're trading what are effectively your standard options, but just saying, hey, make them European for me. So maybe we'll see that. Maybe we'll see a new class of European equity options as well. I don't know. It was a lot. It was fascinating talking to everybody this past week and seeing what is top of mind for them. Oh, by the way, I buried the lead there about 24-hour trading, your number one pick. It does seem like the exchanges are pretty giddy for that, Dan, and that's because they see gold in the international hills, right? They see people in Korea and Europe and Japan, wherever, they want to sling more of their products, and so they want to open that up. That's not really aimed at the U.S. retail trade. I mean, certainly you can go in if you want and trade in that overnight session as well. I talked to the folks on Robinhood. They already kind of approximate this on their platform. Now they allow 900 some odd names you could trade in, I think, that are 24/5, something along those lines. So a fair amount of names you could trade over there. So they kind of approximate this already. So I wouldn't be surprised to see this happen. Probably not this year either. It's going to have a lot of regulatory rigmarole behind it. But I wouldn't be surprised to see the 24-hour thing maybe start happening sooner than the other stuff, just because the exchanges see money there. And these are all for-profit public entities now. Just like with Flex, they're going to chase Flex because there's money there. And they're going to chase this 24-hour thing because they want that guy who wants to sell 5,000 SPX options in Korea at 3 a.m. our time. They want to let that customer have his way, Dan. So interesting stuff out there. I never will short sell the exchange's desire to make money at the end of the day, Dan.
Yeah, you would be on the wrong side of that bet. That's for sure.
So that's kind of my takeaway from OIC, and also a little bit of a surprise. What the heck are flex options? Because those are going to be a thing, apparently, again, and they are a thing right now. And you might be hearing about them more in the coming days, weeks, months, and years. So if you hear about a flex option, there you go. You heard it from us first. It's a non-standard option, effectively. That's usually traded for large size by institutions, and it's kind of a request for, quote, one-off type of trade. There you go. Not really going to be for you folks, but it can be gumming up the works on the open interest side. So something you should be aware of. And you know what? I don't know if any of us should be aware of the question of the week in the mail call, but I guess we should do it anyway. Let's get to a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
right, listeners, I know you've been waiting with bated breath, maybe sipping on your own basement moonshine, waiting for this moment where we unleash the market taker. Question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
Dan, I'm not going to lie. I just like hearing the danger zone.
Oh, good. Well, yeah, turn it up so I can't hear my stupid dog barking in the background over here.
What's up with Flexi today? What's going on?
Oh, geez. So, question of the week is, what is the ideal time horizon for a collar? And this is a good and interesting question. We could talk quite a bit about this. I've done some consulting gigs talking specifically about this for concentrated wealth positions. But as much as we can do short-term collars, they tend to work better long-term. They tend to work better where we're going out at least 6 months, 6 months to a year, and kind of treating it a little bit as set it or forget it, which is not universally true, because if it is a concentrated wealth position, you might have acquired that stock 20 years ago when after, split adjusted, you bought it for $1 and now it's trading for $500, and you don't want to get assigned and have to pay taxes and such on that. But, that's sort of the philosophy, is that it is long-term. If the call ends up getting into the money and you might have to do an adjustment or something, so be it. But yeah, we like to keep them longer term. You just tend to get better prices. They tend to work out better that way.
Yeah, and it's interesting. There was a lot of research done on this. In fact, when we kind of first launched the Options Insider, Dan, all the way back in 2007, if you can believe it, OIC at the time, they had just spun up their institutional division. And one of the first real studies they did was called Collaring the Cube. It was a study on the Q and doing collars on the Q and ways to play around with the call and the put and see if that somehow impacted the outcome. And then they took that same study and then they expanded it to just about every asset class you could think of. So precious metals, energy, other indexes, single name stocks. It was at the time kind of the most comprehensive collar study I've ever seen. It still is worthwhile, I would say, for anyone out there who's curious about this topic of optimal collar construction. And at the time, obviously, this was, I think the first version came out around 2000. They updated it in 2009 and stuff. So there were no real weeklies at the time. Obviously, there was no 0 day. So you might have to redo these numbers with this new kind of modern market framework in mind. But their finding was pushing out you mentioned long-term. That was kind of their finding as well. They were talking about pushing out the put probably at least 6 months. 6 months was kind of the sweet spot they found. If you went maybe beyond a year, you were paying a lot for that put, but somewhere in that 6 months to 1 year of course, you're delaying the impact of time decay then. You're obviously getting a little bit less delta. You're paying a little more for it. So there are some downsides to it. But then what you do is turn around and you sell a near-dated call against it. So you're pushing the protection farther out. You're moving the income component nearer dated. At the time, they only had monthlies, so they looked at it in the monthlies. I'm sure if you did it on a weekly basis, it would be an even more compelling thing. And what they found, Dan, was that sweet spot was somewhere around that 6 months for the put and about 1 month for the call. And then if you rinse and repeat the call 6 times, over time, it should offset most, if not all, of the price of that put, and you had a pretty decent protection level at the same time. So it was pretty interesting. I know they applied it to a lot of different asset classes, which is also fascinating because things like gold obviously trade with a very different volatility skew than something like the Qs or the S&P 500. So you're going to get a lot more for that call when you're selling it in metals, and you're going to pay a lot less for the puts than you are in an equity index and vice versa. So it's a fascinating thing. I encourage you listeners, head on over to the OIC website, optionseducation.org. Look for this Collaring the Cube, or just looking for collars in general. They hopefully will still have links to some of this data up there, because for a long time it was the gold standard, Dan, in collar research. And it still is worth looking at because they did a broad variety of asset classes. So I would encourage anyone listening to check that out. Dan, have you ever checked out these studies?
No, I haven't, but that sounds really interesting. Yeah, I think I'd kind of like to, I'll tell you the truth.
Yeah, to my knowledge, they haven't updated them in the last 4 or 5 years. I wish they would because it's great research. I don't know anyone else who's really done this amount of data. Maybe outside of Matt does a lot of back testing. He probably has back tests on collars, but no published studies to this level of detail. So if you are intrigued, optionseducation.org listeners, or search for collaring. The cube is the initial one. That was the one they focused on the Qs. And then from there, they did other ones, and I'm not sure what they titled the other ones. And that was when they looked at multiple asset classes, which I think is the one that's more informative. But check that out, listeners. It's a fascinating study out there. Speaking of fascinating things, Dan, we've got 2 questions of the week right now that are burning up the audience. One kind of a fun one, a silly one that was inspired by our discussion yesterday on the Option Block show, which you should be listening to if you're listening to this, listeners. And then B, one more related to what we were just talking about with OIC. I kind of gave my thoughts on our question of the week already, so I probably shouldn't have said that. I don't want to gum up the results for the poll. But our actual question of the week is, do you think we'll have listed 0-day options in Tesla, NVIDIA, and Apple before the end of the year? Yes, no, or I don't trade 0 DTE. And then the fun one, Dan, we threw in there just for fun, as we were debating yesterday about Apple on the Option Block show. And it's a funny time where Warren Buffett is making headlines about how he's selling a lot of his Apple shares. Meanwhile, Tim Cook at Apple is buying a whole bunch of it. So you kind of have a push-pull. One's selling, one's buying. So which side of that trade would you rather be on, Dan? Selling Apple or buying Apple? So a twofer. Do you think we'll get 0-day this year, yes or no? And then B, which side of that trade are you on? The Tim Cook side or the Warren Buffett side?
I think it's probably likely at some point we will get 0DT in these super liquid stocks, but I don't think it's going to be, I doubt it'll be this year. Hard to say. I wouldn't be surprised if it is, but I think it'll take a little bit longer. And as far as the other question, I lean towards the Tim Cook side, because yeah, Buffett has been or is selling off some of his Apple that he bought a gazillion years ago, which is my understanding he's doing to free up some cash, but he still kind of sings Apple's praises. And Apple, it seems to me, has reached a more mature level. And so maybe they're not quite the rocket ship they have been, but Tim Cook and his advisors, I think they know what they're doing, and they certainly have the intel on Apple, and so it's really, really hard to go against Apple buying its own stock. Any company buying their own stock, they're doing it for a reason. And in fact, if you read up on sort of Warren Buffett's investing style, like he will take that as a very, very good sign that it's a solid company. So yeah, I've got to lean towards the Tim Cook side on that.
Well, our audience is saying sold to you, Dan. 2/3 exactly saying they're going the Warren Buffett way. Only 1/3 is going the Tim Cook way. So they're saying, you know what, Apple's out of ideas. They're spending all their money on stock because they have nothing else to do with it and paying a dividend instead of making something new and innovative. So they're done. They're out. And they're going the Warren Buffett route. So they're saying pshaw to you, Mr. Dan. And let's see here. And then our actual question of the week right now. Our audience a little more optimistic than you or I on this one, Dan. Are we going to have listed 0-day this year? 42.9% right now are saying yes, Dan. 38.1% saying no. 19% saying they don't trade 0-day. These people obviously have not heard our stuff from OIC yet because it hasn't gone live yet. So once you hear it, maybe the voting will change. But yeah, they're optimistic. I don't blame them for wanting nice, shiny new things, Dan. I just don't think we're going to see them this year. So yeah, I'm on the no side. Sounds like Dan is on the no side. But our audience, uncharacteristically optimistic, Dan. There you go. They're fading the heck out of you on Apple, and they're loving some 0-day. That's our audience on the show for this week. All right, Dan, That music means we've come to the end of another sojourn through Options Bootcamp. If you had told me when I came back from North Carolina that we'd be talking about flex, I would have said, you're a crazy person. But that's where we are in the year 2024 in the options market, Dan. It's all about flex. Crazy.
That's surprising. But you know what? I mean, look, I know the show's kind of over here, but the bottom line is this stuff only works if people trade it. So, like, the proof is going to be in the pudding there. Like, the exchanges can be talking all they want about flex, but if nobody trades it, it ain't going to work.
And folks are apparently trading it in size. So that's the thing. They see money, they're going to go for it. So expect every exchange to offer cutting-edge flex. Dan, who knew you were so ahead of the curve when you named your dog Flexi about 10 years ago? Look at you. You said, you know what? I remember you telling me at the time, you said, you know what? I think the show was pretty new then. And you're like, I think this flexing's coming back. I'm going to get in early on it, and I'm going to name my dog Flexi. And here you go. A decade or so later, it is all bearing fruit. I tip my cap to you, sir. You missed the kind of Bitcoin wave, but you got in on the flex thing, so there you go. Good for you.
Yeah, there we have it.
In the meantime, sir, if they want to come to your MTM land and learn how they should name their dogs after obscure options terms, where should they go? What should they do?
Make your way on over to markettaker.com, and it's 2 T's in a row. And just click join free, and you can message us. You can get free access to our chat room for the time being. And hey, we even still have some seats in Sonoma this June if you want to meet us up in person.
There you go. Check them out. Market Taker. Don't forget the second T for theta.com is the place to go to learn more. And again, check out that collar study. I think you will find it valuable and informative, listeners. And unfortunately, a lot of people haven't updated it since, and no one else has run with that. So that's kind of it. So go check it out. Collaring the Cube, and then the updated version with all the asset classes. Maybe had a similar title, I forget. But intriguing stuff nonetheless out there. Optionseducation.org is where you can go to find that fun, or just search for that name, and it should hopefully come up. At least the abstract will come up for you. That's going to do it for us on the network today. Listeners, a rare one-show day for me. Look at that. The producer is being nice to me. After talking so much last week, they give me only one show today. How nice of them. Back again tomorrow with our usual doubleheader on Thursday. Got the option block with our buddy, the Flow Master from SIBO. And then after that, This Week in Futures Options, talking all the action over there on CME options. If you're wondering how I'm so conversant in metals skew, that's why we do a show about it every week. So you should be checking it all out if you're not over there. Just wherever you're listening to this, make sure you're getting the full network. Search for Options Insider Radio Network. All those words, you'll get it all. And then you'll be subscribed to everything we do, and you won't miss a beat. Back again on Friday, Volatility Views. That's a fun one. If you are intrigued by all things vol, you should be checking that show out. Followed by Options Oddities, exclusively for our pro folks. TheOptionsInsider.com/pro is the place to go to learn more about that. Congratulations to our longtime pro member, Age Del Aquarius. He won our April Pro Trading Crate. If you want to win the May one, get on over there. TheOptionsInsider.com/pro, the place to go to learn how you too can win fabulous prizes. And then we're back again next week, all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores.
Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.